Hi, I'm Professor Suneel Maheshwari with the Department of Accounting at IUP. Today we'll be talking about current liabilities and how to account for the current liabilities in the balance sheet. What are current liabilities? First of all, these are obligations which are due within 1 year or within the operating cycle if longer than a year. Your liabilities which you have to pay off can be a known amount or it might be an estimated amount. What do we include in the current liabilities? There are a lot of items over there. For example, accounts payable, short-term notes payable, sales tax payable, some of the payroll liabilities, and current portion of the long-term debt, unearned revenues. In terms of accounts payable, whenever the money is owed for the product or services that are purchased on account, and those are accounts payable. Accounts payable turnover is an important measure of liquidity. It basically measures the number of times a year company is able to pay off its accounts payable. So accounts payable generally arises due to the normal purchase of goods for the business. So how do we compute the account payable turnover? We take the credit purchases and divide it by the average accounts payable. What is average accounts payable? You take the beginning balance of accounts payable, add the ending balance of accounts payable, and divide it by 2 to get the average accounts payable. So purchases from suppliers divided by the average accounts payable. Another ratio that is related to it is the turnover. Turnover is expressed in number of days. So if you take 365 days of the year and divide by the accounts payable turnover. So if you got a number of say 30 days, it basically tells you that you're paying off your accounts payable in about 30 days. And short-term notes payable are the notes that are due within 1 year. And generally, they're used to borrow cash or purchase any asset. On the short-term notes, you will pay or accrue interest, and it is payable at the end of the note's life or the period when you are supposed to pay off the principal plus the interest. So in short-term note payable, the computation of interest will need to be done to accrue the interest as an expense for the period for which the money has been used. For example, you purchased inventory costing $8,000 and it accrued interest at 10% using a short-term note payable and it is due in 1 year. So you've got your inventory of $8,000 and then you've got a note payable liability on January 1st for $8,000, which is your short-term liability or a current liability is going up and is credited. Then at the end of the year, you've got an interest expense of $600, which is payable at when the note accrues. Since the fiscal year is ending in September, we accrued the interest for 9 months, that is from January to September 30th. Now, after September 30th, on January 1st, when the note is due, you have got the notes payable short term because you're going to pay it off, you're debiting it. Interest payable, which you computed on September for $600, and then you have to compute the additional interest for the remaining 3 months for the month of October, November, and December, which is $200. And you pay this off the total amount of $8,800 to extinguish the short-term notes payable liability. As we have got, there is another short-term liability called the sales tax payable. Sales tax payable is collected by companies on behalf of the government, and then it is remitted to the government every uh, every so often. And until it is paid off, it is shown as a liability. So you got sales at Home Depot for $200,000 and all in cash, and it was 5% sales tax was collected, so $10,000 in sales tax was collected. So you got cash of $210,000, 200. Then you got the sales revenue, which will be recorded for Home Depot, and a sales tax payable of $10,000, which is due to the local authorities. Similarly, there are certain other liabilities like salaries and wages payable, interest payable, income taxes payable. All these liabilities have the word payable in it, which basically means they are due or to be paid at a certain point of time. Now, coming to the payroll liabilities, it comes in different forms. It is called employee compensation, and for many companies, it is a major expense. It can come in the form of salary, wages, commissions, or bonuses. Salary expense represents the gross pay. What does that mean? Not only there is a salary that is paid to the employee, but in addition to that, there are some payroll liabilities that are created. So the employer deducts the employee income taxes that are payable to the federal government, state government. Also, it collects the FICA tax payable, which is basically the Federal Insurance Contribution Act. That consists of other two items, which is the Social Security tax and Medicare tax. In case the individual is earning more than $200,000, then there is also an additional Medicare surtax that is deducted under FICA taxes. And then there's a balance of salary payable, which is done. Companies will also have to pay their employer share on the payroll. So here are some of the numbers that have been assumed. Suppose your salary expense is $10,000. Your income tax payable is $1,200. FICA tax payable is $800. Once you have paid those 2 or 3 items, then the balance of $8,000 is sent as a check or directly deposited into the employee's bank account. Another category of current liabilities is called deferred revenues or unearned revenues. Why are they called unearned revenues? Because the business has received the money for it but has not performed its own part of service or has not delivered the product, and therefore it results in an obligation on behalf of the company to deliver those services in the future. So for example, on December 15th, Southwest Airlines collects $300 for a round-trip ticket from Dallas to Los Angeles. On December 28th, the customer flies to Los Angeles. So in this case, the sale or the money was received on December 15th. However, the first part of the service was provided on December 28th. So out of $300, one leg was done on December 28th for $150. So on December 15th, the first is you're acknowledging that you have received cash of $300 and you have got an air traffic liability of $300, which is created. Now on December 28th, part of that liability goes away because the customer has flown one leg of the flight. At the same time, you can recognize that part as the revenue for $150. On the return ticket, if the customer flies back on January 4th, we have got a similar entry which we did on the first leg, which is air traffic liability debited by $150 because now your liability balance has gone down to zero, and the ticket revenue of $150 because the company has now completed its liability relating to providing that service to the customer. Here is another illustration for an unearned revenue. Suppose Wortham Publishing Company sold 1 year subscription for $2,400 plus collected a sales tax of 9%. It remitted on November 15 the sales tax to the state of California, and on December 31st you are required to make the necessary adjustments. To journalize the transaction for October 1st, you got the cash of 2,400 times the sales tax rate, which was 9% for California over there, and so you have multiplied that 2,400 by 1.09 to get total of $2,616 in cash. Since the revenue is still not recognized, it cannot be recognized because the services have not been provided. It is called the unearned subscription revenue of $2,400. And then there is a sales tax payable of $216. This sales tax payable of $216 is paid on November 15th. Therefore, your sales tax payable is debited by $216 to bring that balance of the account to zero, and cash has been credited by $216. The last part is on December 31st. You have recognized part of the revenue for $600 from October 1st to December 31st, and therefore debited the unearned subscription revenue by $600 as you recognized it for the month, 2 months, 3 months. When a company takes a long-term debt, it might pay part of the debt in the current year if it is due. So the current debt or current portion of the long-term debt that is due in the current year, along with the interest on it, is shown as part of the current liability. So company will reclassify amounts from long-term to current liabilities. In some cases, current liabilities will need to be estimated. For example, in case of warranty, you might need to estimate the liability based upon the history of the company as to what has gone wrong in the past, and based upon that, an estimate might be made. Contingent liability is a potential liability that depends on the future outcomes. For example, a lawsuit might come against a company, and it is the results or the losses are based upon the outcome of the event. So, and we don't know what the outcome is. So in that case, this liability is called contingent liability. For accounting purposes, you can either accrue a contingent liability or disclose it in the footnotes of the financial statement, or do neither if the likelihood of that liability is nearly zero. So let's take an example of estimated warranty payable. Here is Black & Decker, made sales of 100,000, subject to the product warranties. Assume that in the past it has been between, defective parts has been between 2 to 4%, and therefore Black & Decker estimated that 3% of the sales will require repairs. So 100,000 times 3% of the sale will give you 3,000. So we have recorded a warranty expense of $3,000. At the same time, you have got an estimated warranty payable of $3,000. So we have created a liability for it just in case it might take place in the future. Assume that the defects added up to 2,800 only instead of 3,000, and Black & Decker will replace the defective part. You had a opening balance of $3,000 in the estimated warranty payable. Now you debit the estimated warranty payable by $2,800. So you are using $2,800 of that $3,000 liability that was created, and your inventory is credited by $2,800. As far as the contingent liabilities are concerned, if the liability is probable, you will accrue it and you'll disclose it in the notes to the financial statements. If the liability is reasonably possible, you will only disclose it in the notes in the financial statements. If liability is remote or unlikely to happen, then no action is needed in the financial statements. So you have to establish whether the contingent liability is probable, reasonably possible, or remote. Thank you very much for listening to the presentation. Have a nice day.